exciting information about inventory, COGS, accounting, etc. So yeah, thanks again for the introduction. Basically, we're going to talk about how to leveraging your margins to produce better returns without spending more. So I'll start the presentation now. So basically, kind of today's topics we'll discuss will be, as we've discussed, kind of the 4 subtopics will be what to consider when accounting for inventory and COGS, tools to use to help you calculate COGS and identify your margins, what KPIs or key performance indicators on the P&L should you be focused on, and then the benefits of segmenting your reporting by sales channel, customers, and even products. So that's kind of the high level. We'll get into it as we move forward. And as Carol said, if you have any questions, type in on the chat box, and at the end, I'm wide open for kind of verbal questions as they come up, because I know a lot of you may have some questions on these, especially as we go forward. So just want to kind of give a background of Accountfully. I'm here headquartered in Charleston, South Carolina. We have a second office in Nashville, Tennessee. We're a team of about 35 people. Basically, our core services, we're an outsourced accounting department for small businesses. And one of our biggest niches, actually our biggest niche, is in the CPG space for emerging brands. We work with clients from basically $0 revenue to around $4 to $5 million in annual revenue. So we work with a lot of clients that are in that space. When you work with us, you get a dedicated team of a bookkeeper, controller, and a CFO on your account. So clearly like an outsourced accounting team. And so it's a mix of bookkeeping execution, weekly support, and advisory expertise, or kind of CFO level expertise. And with that, we have clients all across the nation, and specifically within the CPG space and food space, we have clients that have varying supply chain complexities. So we have some clients that basically, have a turnkey co-packer. They buy a finished good, and then they buy a finished good and then resell it. So they're kind of managing our inventory or supply chain complexities much less. Whereas we have other clients that are in-house manufacturers, purchase everything, have a much more complex kind of inventory accounting, cost of goods accounting process. A lot of our clients are in the middle of that, where they're working with a co-packer or multiple co-packers, buying some raw materials, the co-packer sourcing other raw materials, and then putting them all together, right? And then taking them to a 3PL and having multiple locations to sell their product, etc. So why I'm saying that is we deal with a lot of different types of brands and clients. Additionally, similarly, a lot of our clients have multiple sales channels, selling on their website. Typically, we have a lot of clients, most clients are on Shopify, selling on Amazon, whether FBA or fulfilled by vendor, through a distributor, KE, Unify, etc., direct wholesale, food service, etc. So then we also understand how to account for those brands in terms of from a multiple sales channel standpoint. So the two things, bringing those up, I just wanted you guys to understand where we're coming from in terms of this conversation, in terms of kind of the expertise and the knowledge we have within this space. As we've grown, we've kind of had an inventory department where we've actually brought it out, where we focus on accounting for inventory and COGS, implementing inventory systems to help clients manage the purchase to sales process. And then additionally, we offer deduction management services with distributors like Unify and KE. So just understanding that, I wanted to kind of preface that so you understand where we're coming from, and that we do have industry knowledge when we're talking about the several aspects or topics moving forward. So first thing, I just want to step back from understanding high level of accounting for inventory and COGS and cost of goods sold. So point one is making sure that we're accounting on an accrual basis for that. And basically what that means is making sure that you're matching the cost of the goods sold to those revenues that occurred at that time period. A lot of clients come to us because they're basically posting all of their inventory purchases directly to the profit and loss statement. And then basically they're not matching them up to the revenues. And so the margins and the reporting is not even relevant to help them run their business, right? The goal of what we're trying to do here is to give you proper and really good information at a detailed level to help you run your business and make good short-term and long-term decisions. So in order to do that, you really need to move to an accrual-based accounting. And that's, again, means that you're taking the revenues and you're matching the cost of those products sold over basically for a month time frame. And how you do that is you post the inventory purchases to the balance sheet, and then you move to the P&L when they're sold or when they're shipped, those items. So kind of the inventory accounting can be very complex, right? Or it can be relatively simple. It depends upon your needs, right? Well, we always tell our clients, especially depending upon the stage of business you're in, if you were coming to Accountfully or an accounting firm and you're like, look, I just need to get my system set up. I have 4 SKUs. I use a turnkey co-packer, and I'm just selling on, direct to consumer on my website. Let's keep it simple. Let's not get too crazy. Let's keep it simple. We can always add complexity as you go forward. And by that, I mean, like, how many accounts do you want on your financial statements? Inventory, do you want that broken out by raw materials, work in process, finished goods? Or can we just have one inventory account? COGS, do you want it broken out by product COGS, freight, and packaging? Do you want labor broken out, or can we kind of bundle them all in based upon a calculation? Again, the extent of how many accounts you have adds in more complexity, which adds in more time, as well as adds in possibility of more mistakes. Understanding timing of sales versus shipping, right? So you need to understand that really when you're recognizing revenue is when you ship the product out of your warehouse or out of the 3PL. And that's key, because if you don't properly account for that, then there's going to be some mismatching when you basically post cost of goods sold versus doing your monthly inventory counts of what you own. So understanding those 2 aspects. A big thing that I see our clients that don't come, or that we're with other people that come to us, is they're not accounting for samples properly. They're actually baking their samples into their cost of goods sold. Well, that's not really the case. Samples are a marketing expense. You need to understand how many items you're selling or giving away to help, create revenues and sales in the future. Well, you need to make sure you have a process in place for that, depending upon whether you fulfill your samples through Shopify, through your 3PL, to your prospective influencers or prospective buyers, etc. We need to make sure we have a process in place for that, so then you can understand that, and then you can assess ROI on that. Where do you house inventory? That's a huge aspect of what needs to get done, right? Where do you still own the inventory at what locations, and what is the process for ensuring that you're properly accounting for your inventory on a month-over-month basis in terms of what you own, the quantity you have, when you need to reorder, etc. Accounting for freight in and freight out. What does freight in mean? Freight in typically is baked into your landed cost of the product ready to sell, whereas freight out is typically kind of a fulfillment or post sale expense that is a variable expense that should be assessed, and when you're basically sending that shipment out to the customers. And the last thing is prepaid inventory, right? You may spend $50,000 on inventory you haven't received or won't receive for a couple of months, but we need to make sure that we account for that properly and not compare that to what inventory you have on hand as of that date. So you guys can see kind of 5 or 6 complexities here that exist with inventory in COGS, and it is complex. And as you grow the business, as you have more sales channels, as your supply chain gets more complex or more touch points, it can get very overwhelming in terms of how to account for it. But if you don't do it right, you don't really have really good information and timely information to make the best decisions for your business along the way. Tools to use. So in terms of some of the tools to use or to manage inventory, to understand all this entire process. So a lot of clients, again, in the space I'm talking about, the 0 to 4 million, right? A lot of it's like 500K annual to 1.5 million revenue annual clients. A lot of it is upfront manual, right? Using spreadsheets, Google Sheet, Excel to manage your inventory, right? To basically track all inventory accounts at all locations. So basically, I need to go to Amazon, see what I have on hand at their warehouses. I need to go to my 3PL, see what I have on hand at their warehouses. I need to count the inventory I have at my office or the warehouse that I'm at right now, right? And then within that, you put it into a spreadsheet and you manage it that way, right? In terms of what I have on hand. And that's from an inventory valuation standpoint. Remember, the one thing I will say is that outside of your people, which for inventory-based companies, it's not even, you don't compare really, but inventory is your biggest spend, right? That's where your money, which is a finite resource, goes. Most of your money goes to that. That's where investors give you money to pay or to create and buy inventory. You need to have a proper control over those items, where they're at, what you want at a specific time, and when you need to reorder those products. We don't want to just lose products or have no idea where they're at, or have to do inventory adjustments or shrink inventory based upon you not knowing where things are at, or you losing those items. A big thing that happens is calculation of standard cost, right? So when you're doing things manually, you need to calculate the standard cost or the average cost of all of your finished goods SKUs, right? The products that actually you're selling or somebody's buying. And what does that mean? That basically means that you are taking all of the costs that it incurs to get from raw material to a finished good ready to sell in your warehouse. or in the 3PL, right? Or in Amazon. Basically, that is everything that goes into play. What's included in that? Raw materials, co-packing, labor if you're basically in-house manufacturer, packaging, freight in, because getting freight from raw material to your warehouse, etc. Duties, taxes, that all of that stuff goes into play. So in terms of calculating all those items, understanding your finished good, understanding what the bill of materials or assembly is that makes up those products, and adding all those up and creating an average cost for your finished good or for your SKU. And that's super key to understand, where you need to basically understand that, because then you say, hey, my average cost or standard cost for the SKU is $4. Well, I'm selling this for 10. So then you can start doing margin analysis and price your product, right? We have some clients that come to us after we do this process, and their standard cost is higher than their sale price because they forgot some things or didn't really look at it properly. So this is a huge practice that should be done prior to really, calculating your sales prices or retail prices, etc. Essentially, we kind of created an inventory workbook, which kind of goes through this entire process of manually understanding your supply chain, understanding your raw materials, your bill of materials, your assemblies, calculating finished goods of those products, kind of doing a calculation of your margins, and then on top of that, implementing an inventory valuation process, inventory count process on a monthly basis. Inventory systems. So when you want to get to the point where you no longer want to do it manual, you want to invest in kind of a system to help manage this, that basically does a lot of the things I chat about in a more automated manner, then we highly recommend that, because these tools are really cool. The one that we use for the most part is called Deer Inventory, but they're cloud-based tools to manage inventory from the purchase to assembly to sales process. A lot of these systems are cloud-based. They integrate with Amazon, so sales that you sell on Amazon sync into there automatically. Shopify, ShipStation, you can do your fulfillment through there. There's EDIs that come into there, etc., and all that data can go down to QuickBooks Online or Xero, whatever your accounting application is. So there's much more automation in the process. It calculates the COGS very precisely. It actually does it continuously, and it'll calculate it to where the standard cost calculation up top is not relevant, because these are actual costs that are coming into play, and that you can do it on a kind of lot or expiration standpoint if you're in the food industry. And basically what it allows for, if you're doing it right, it's a continuous accurate view of inventory on hand, accurate and precise cost of goods sold, etc. And it helps you basically to automate kind of the reordering process, right? When you're purchasing products, which basically are a function of quantity of hand, lead time, kind of amount, your turn of the products, etc., right? Safety stock, all that stuff. And some examples are Deer Inventory, Fishbowls, and 7SLS Inventory. Highly recommend looking into those, make sure they're cloud-based, make sure there's a lot of data sync and integration with all that stuff. KPIs to review in the P&L. This is a huge one where we kind of look, and this is how we structure the P&L for our clients, and this is what we highly recommend it for you guys to do. Number one, gross revenue. We need to understand top line revenue. You need to understand what is quantity sold times gross sales price. Number two is net revenue, right? When you back out those deductions from the MCVs and from your distributors that come into play, the discounts you give on your sales on Shopify, the refunds of processing back refunds, etc., right? Understanding kind of what your net revenue is. So gross revenue is top line. If you had none of those, net revenue is basically top line less those deductions, discounts, etc. So it's still the number you're going to bring in, but it's lower, right? COGS, we just chatted about that. The quantity of products sold times the standard cost of those products, or the actual cost of those products. And then what then happens, then you move to gross profit, which I'm sure a lot of you are aware of, gross profit, gross margin. And basically what that's doing is that's assessing the total landed cost, which basically means it's ready to sell in your warehouse or 3PL, right? It's ready to sell versus the actual net revenue that you brought in. So basically think of it again as it's a way to assess all your costs prior to it being ready to sell versus the actual revenue that you get. Right, so it's this side of the business. So you can then understand, hey, am I spending more money over here? Or are my costs going up on my raw materials and my packaging, etc.? Okay. Next is contribution margin, where basically you're assessing costs to get that product ready to sell from your warehouse to the customer. So it's post-sale, right? So gross profits pre-sale, contribution margin post-sale, right? So post-sale, what are those costs incurred? What do they mean? Basically things like pick and pack fees, right? Freight out expenses, warehouse related expenses related to those items, right? Credit card fees that you're processing, Amazon fulfillment fees, right, that come into place. So then what you're able to do along that is you can calculate what's left over from that to net revenue. So then what you're seeing is the reason we distinguish between gross profit and contribution margin, because then you can understand where are my costs, impacting me. Is it post-sale, is it pre-sale? Because sometimes, like, if you just look at them all at once, it's hard to kind of understand. Or if you look at them separately, then you're like, oh, my freight's going up. I'm good over here. You know what I'm saying? So that's why we do it differently, kind of along the way. And basically, it's still a way to kind of look at it from a variable expense standpoint. And then the last thing is operating profit. So then basically you take that number, then you back out your, your sales related expenses, your G&A, your advertising, marketing, your R&D, et cetera. So from a kind of summary of this, KPIs to review: gross revenue, net, COGS, gross profit, contribution margin, and operating profit. That's how you should set up your chart of accounts. And kind of the last thing here that we'll talk about, and I'll tie this all together, is report segmentation, right? So overall P&L, which we just chatted on, we can have that as a company as a whole, right? Like, which is great because that's what you report on to the investors. But what if you could segment that by different sales channels, by your customers, or even by your products and product lines, right? What if you could do that so then you can say, hey, my company overall is profitable, but what if Amazon, you're losing your money, you're a lot of money on, but you just don't see that because you're not segmenting it, right? So doing that within your P&L and within your QuickBooks really helps out, because what we're able to do by breaking out from direct to consumer, Amazon, direct wholesale, distribution, food service, is we get a fully loaded cost between of all your revenues, of all your costs of goods sold, of all your expenses. So for example, let's do like an Amazon, right? You get those reports, you get deposits from Amazon that come in. Well, if you're just looking at it on a cash basis, you're like, wow, money's coming in the door. But what we really need to do is say, okay, let's post gross revenue from Amazon. Let's back out the discounts and deductions that come into play. Post the cost of goods sold, which aren't shown on the Amazon reports, right? So the actual cost of the products. And let's basically back out their fulfillment fees, everything that they're doing kind of from an FBA standpoint. And then on top of that, what if we then back out advertising spent on Amazon and other maybe sales commissions that you're using, maybe a broker or a commission partner specifically for Amazon sales? What if we include all those items in an entire ledger and then allow us to say, wow, we're losing money. We didn't realize that because we saw money coming in, but until we factor it all in, all of those expenses plus the product costs that are associated with it, then do we really get a good view of what's going on within that sales channel. We can similarly do that at a customer level, right? You can do it at distribution, but then you can break it up by UNFI and KE. So it really allows you to kind of understand and break down your business of where am I profitable, where am I not profitable, where do I want to focus on. And like that's the last thing, understand exact KPIs for each customer's sales channels. Where are you profitable? Where are you losing money? And any changes that can make in a relationship. By that I mean, can you tweak the your sort of commission structure within that sales channel or that customer, or your pricing within that sales channel. Overall, when you're able to kind of segment the reporting and get more precise reporting at those levels, then you can just make better decisions overall and tweak different things within those specific segments that then help your company overall. So overall, so kind of coming back to producing better returns, what is this really having to do where, hey, how do we leverage our margins and our reporting and our data we're getting to produce better returns without spending more? That was basically the title of the webinar here, is kind of as we go through here, right? Number point one is making sure we're properly accounting for inventory and COGS to give us good data. Remember, back on an accrual basis. Let's leverage tools to automate processes, create precision or precise data, and provide real-time information. Whether we do that manually or we use tools like your inventory or other things like that. Let's also make sure that we have the chart of accounts structured properly so we can review the appropriate KPIs and margins and metrics that we need to focus on. And then let's segment at the appropriate level, specifically sales channels and customers for the most part. And then if we're able to do all those items properly, then what are the decisions that you can make in a downturn, like what we've been going on in the last 90 days, 120 days, to produce better returns, i.e. get more cash in your business without spending more? Well, a couple things to think of. If we had all this data and we were doing it right and we had real-time information, which sales channel, customer, or product can you discount and still hit your margins that you want to, right? So then you may have some more profitability based upon your relationships with specific customers or sales channels you have, or specific products that you have that you bought on discount from your vendor that you can basically maybe discount and still hit your margins that you want to. What sales channels or customers should I target ad spend already budgeted? So this isn't spending more ad money. This is our, hey, I already budgeted this ad spend. Well, if I have it broken out, maybe I change it from Amazon to Facebook or to Google or wherever your ad spend is, right? You need to have a marketing person, or you guys handle that to make sure you see your kind of, cost to acquire a customer, lifetime value of the customer, and kind of ad spend, return. And then the last thing is, what product do I have a lot of it in inventory that I can sell? So for those of you that have multiple locations of inventory, Amazon, your warehouse, multiple 3PLs, your co-packer, well, understanding that and putting it into a spreadsheet or a system to say, how much total do I have of this? Well, you know what? I have excess. Let's discount that and let's get that out the door to then be able to generate more cash for me without spending more money. So at the end of the day, the summary of this all is accounting for your inventory and COGS properly and proactively and segmenting in a good way can help you make better decisions for your business, not even in a downturn, but clearly at any point of how good the accounting is going. And it's a key attribute to kind of you as a business owner to be able to run your business properly. So hopefully that was a lot of information. I'm sure it was a lot of information, but any kind of questions, comments, concerns that have come up here?
Thank you, Brad. That was a lot of information, but it was very comprehensive and I guess very useful. And as you mentioned, this knowledge is valuable during downturns, but also on the long term. So we hope that our audience is benefiting from that. So as a reminder for the participants, if you'd like to ask questions, you can please, you can unmute yourself and ask the question directly to Brad, or you can send us the question via chat and we can ask it on your behalf. Does anyone want to ask a question?
I would love to ask a question. This is Sally Murphy. Brad, do you or Accountfully advise clients on pricing strategy?
We can, but it's a mix of, there's multiple parties that need to be involved, right? So number one, like we can really help you behind the scenes on the COGS, the build out your standard costs, really understand your costing structure, right? On the other end, then, we can easily say, hey, let's, here's a margin, the traditional kind of sales channel margins or markups that are needed. But on top of that, then there needs to be somebody on the other side from the sales side, market fit. Hey, can this product go out there at this price point or things like that, right? So Accountfully is not going to be able to support you in that, but a lot of that stuff is built up by kind of what is the structure of my product costs, what are my unit economics and things like that, which we can help out on.
Okay, thank you.
Thanks for the question. Any other questions out there?
Brad, this is Julie. Thank you so much. That was fantastic.
Thank you.
I just had a quick question. I'm, a solopreneur and I haven't exactly started yet. But I also don't have a background in accounting. When would you suggest that, we maybe employ like your team, or at what point, would you think you should get engaged? I assume probably from the beginning, but and a side note, what is maybe your pricing on that?
Yeah, I mean, it's really, I guess when you get somebody like Accountfully or somebody similar engaged, I would say, it's really kind of, I own Accountfully, right? And when we launched it, I was doing like running my website, right? Which was a complete waste of my time and waste of my energy, right? So understanding that, like, what is the amount of time you're wasting in terms of spending on accounting or sending invoices to customers or things like that, right? So kind of number one is just pure opportunity cost and time spent. When can I transition that time to grow my brand, focus on core operations, etc. Number two, it's much easier to set up accounting systems from the beginning, and it's much cheaper, even though you have like a monthly expense, right? But it's much cheaper to do it now versus in 6 months when you're not doing it, and it takes time to clean up. You don't have information to make good decisions, so kind of that factors into that. And number three, like we work on like a monthly fixed fee. It kind of, for really small startups, you can get kind of the $500 to $750 monthly fee. For typical kind of inventory based clients, $1,000 to $4,000 or $5,000. The majority of our clients are between $1,000 and $2,000 a month.
Thanks so much. Appreciate that.
You're welcome. Any other questions?
We did receive a question, Brad, via chat. Can you talk about direct-to-consumer sales channel and what changes in the model as companies pursue that in lieu of in-store retail or food service?
Yeah. So essentially, a lot of clients that we work with, like let's say specifically work with distributors, right, and get frustrated with, huge chargebacks or things like that, right? But there's a reason why you work with distributors in terms of getting your product out there, right? When you're on direct to consumer, what is the money you need to get? What is the change in the model with that, right? Well, number one, how do people know about you? The biggest thing that's going to increase in terms of going from traditional retail to direct to consumer is ad spend, right? You need to get people moving to your website, or whether you do that, Facebook, Google advertising, or Instagram advertising, whatever you're doing. That ad spend typically goes up a lot more than what you see in the distribution side, where you're getting that trade spend and stuff kind of at the Whole Foods level, at the grocery level, versus kind of doing it like to try to pull people in the door. So there's kind of, that's the biggest change along the way. And then clearly your unit economics change because you're selling, instead of selling 24 packs, you're typically selling individual units, right? 1 packs or 2 packs to somebody on the website. As well as then you have to worry about shipping individual goods in a little box, to via UPS or, via ShipStation, whatever, to your customers versus, selling a packet of product, went to Walmart or to a distributor. So there's a lot of change in the entire business model within each that you need to factor in. But at the end of the day, clearly, like we've seen a lot of clients that weren't in e-com or direct to consumer have switched dramatically to that, especially during the pandemic, right? So again, it's nice to be diversified across all sales channels, depending upon the certain situation that is existing and from the economy, from the economic standpoint.
Okay, thank you, Brad. We're out of time, but thank you very much for this very useful presentation. To the participants out there, if you'd like to connect with Brad, please send us an email at info@branchfood.com and we can connect you with Brad and relay any questions that you might have. Thank you for the wonderful presentation, and thank you all for joining us in this Serving Up support session. Stay tuned as we announce more sessions in the upcoming weeks, and as we strive to further help food entrepreneurs to rebound, I guess, from COVID-19 at this stage and to continue enjoying their operations. As a reminder, you can rewatch all of our Serving Up support sessions, including that one on our YouTube channel, and you can either head over to YouTube, type Branchfood and explore the videos, or you can go to our Serving Up support page at branchfood.com/servingupsupport, and you can get directed to YouTube from there. For any feedback, please reach us at info@branchfood.com, and thank you all for tuning in. Thank you, Brad, for your presentation, and have a great weekend, everyone.
Thanks, Lauren and Carol.
Thank you, Brad. Take care.
Bye-bye.